Good morning. The Committee on Insurance and Financial Services shall come to order. Mr. Clerk, will you please call the roll to establish a quorum?
Chair Carter,
Present.
Representatives McFall, Breen, Rogers,
Here.
Scott,
Present.
Young,
Here.
Fitzgerald,
Here.
Grant, Hoskins,
Here.
Cerniglu,
Here.
Harris,
Here.
Markkinen, Bizat, Aragona, Bruck,
Present.
Nair,
Here.
Smith. Madam Chair, you have 11 members present in a quorum.
Thank you. We need a motion to adopt the minutes of February 7th, 2024 as printed. Representative Fred Fitzgerald adopt the minutes as printed. Hearing no objections, the minutes are adopted as printed. Well, welcome back, everyone, committee members. I hope everyone had a wonderful in-district work period. First up, we have testimony only on Senate Bill 27. Here today, providing testimony on the bill, is the bill sponsor, Senator Sarah Anthony. Senator Anthony, thank you for coming. Please come forward. The floor is yours.
Thank you. I showered today. Good morning, Chair, members of the committee. Thank you so much for the opportunity to address you about Senate Bill 27, legislation to require mental health parity in the state of Michigan. Now, we've all seen devastating impact of the mental health crisis in our state, spanning from suburban, urban, and rural communities. People of all ages, even children, are struggling with anxiety, depression, and substance abuse. And as policymakers, we need to make sure that they have the care they need. And my bill does just that. By codifying federal law, Senate Bill 27 requires insurers to provide coverage for behavioral health and substance use treatment at the equal or greater level provided for physical illnesses. Simply put, we need to be treating mental health and behavioral health the same as we do physical health. Senate Bill 27 aligns with Michigan's mental health parity guidelines with current federal guidelines to promote consistency, access, and quality of care. And the bill will ensure Michiganders have access to mental health care they need and improve mental health outcomes in Michigan. Thank you for your time, and I'll now turn it over to Joseph Sullivan from DIFS to talk more about the department's perspective.
Thank you, and thank you, Madam Chair, for having me in today. So, as Senator Anthony said, Senate Bill 27 would codify into state law the Federal Mental Health Parity and Addiction Equity Act, also known as MAPIA. DIFS has been coordinating with Senator Anthony on this bill since early 2023, and this language incorporates months of feedback. The proposal ensures that Michigan consumers maintain quality and consistent mental health and addiction insurance benefits. As mentioned in this committee with the ACA codification bills, federal action on health insurance reform has been volatile over the past decade or so. With that in mind, this bill would solidify this consumer protection by putting these requirements in the Michigan Insurance Code, which would enshrine DIF's regulatory, enforcement, and compliance authority on mental health parity. I can speak a bit about the evolution of this language as well. So the introduced version simply specified that benefits must meet the requirements of federal law, stating that they could be no less favorable than the level provided by physical illness. Using the term no less favorable in the coverage requirement was vague, so we focused on expanding that. The Senate-passed version broke this down to clarify exactly what that means, specifying that it applied to treatment limitations and financial requirements while defining both of those terms. A provision was added stating that the benefits must meet the requirements of all federal parity regulations, not limited to just the federal MAPIA law. And then stakeholder feedback led to additional language encompassing subsequent guidance that has been issued by CMS since enactment of MAPIA. This was largely technical in nature. So with that being said, DIF supports Senate Bill 27, and we believe that this is an important step forward on the topic of mental health. So thank you for the opportunity to address you today, and I'm happy to answer any questions.
Thank you, Senator Anthony, and thank you, Joseph Sullivan. Do any members have questions? Representative Rogers.
Thank you so much, Senator, for presenting. And I like to say, as Senator Stabenow likes to say, healthcare below the neck should not be treated any differently than healthcare above the neck. So thank you very much for presenting this legislation. We also heard testimony and voted out Representative Braybeck's bill that is very similar. Can you talk about how they do or don't work together and the differences or similarities?
Sure, I can address that a little bit. So the focus of this bill, which we've been working on since the beginning of last year, is unifying the state standards with the federal standards by codifying those into state law. So that bill, not to get into the weeds on that bill, which isn't before us today, of course, would essentially require regulation of state-regulated plans slightly differently than, or largely differently than federally regulated plans by imposing additional requirements on those plans. So this bill, the focus of this is, let's take the federal standards and the federal requirements, codify those into state law. It's not a mutually exclusive topic, but that's what the focus of this legislation would do.
Thanks for clarifying. And is there anything in this bill that conflicts with the other bill? Could, in theory, I'm not asking you to say whether you support the other one or not, but in theory, could both of these move forward without any kind of conflict?
I'd have to take a look at both of these side by side. My understanding, and it's been a while since I've looked at that, there's some requirements in there that would conflict because they go beyond what the federal requirements are. I'm sure that it's possible to do two things. As I said, they're not mutually exclusive.
Thank you.
Yeah.
Thank you, Rep. Rogers. Rep. Sonderglue.
That was actually the same question that I had, but I guess just kind of building on that, and I think you have already answered this as well. I wasn't on the committee at the time that we heard the other bills, but I have learned a little bit about them. So is it fair to say that the other bills kind of just expand beyond what these bills would do for health coverage?
So the main difference with the other bill, and again, that bill's not before us today, this is the bill that's before us. Those bills would impose additional requirements that would only apply to state-regulated plans, so not ERISA plans that are regulated by the federal government. So you would essentially have a bifurcated system that you would have state-regulated plans regulated differently than federally regulated plans, which could have several impacts. I don't know if does that answer?
It does, and so again, I'm a little bit new to the insurance. So for your average individual, would just give an example? Like, would they have different plans, or I don't know. I just want to wrap my mind around how that works.
Again, that bill's not before us today, but that bill would do different things like address in-network and out-of-network differently. It would address different scopes of coverages. It would address availability of coverage. So if that particular level of coverage isn't available, I think the language that I last saw for that bill would require the higher level of coverage to be covered in addition to the lower level of coverage. So there's quite a bit of differences between the two proposals. The focus of this proposal is taking what we know is working at the federal level and codifying that at the state level to enshrine DIF's regulatory authority to make sure that there's that standards are held in place due to any potential volatility at the federal level.
Sure. So this does expand on what's currently happening right now. This will give us more coverage for mental health care in Michigan.
Correct. By taking all the federal standards that are in place, subsequent CMS guidance, and enshrining those into our state statutes to ensure that DIFs can regulate those as we need to be regulating those. So really, it's about providing that clarity and stability should there be any changes at the federal level.
Good. Minority Vice Chair Harris.
Thank you, Madam Chair. Thank you guys for both being here. I always enjoy your testimony. I like to pick on you if I can, but I actually don't have one today. So this is codifying federal law. So we're currently doing this in Michigan now. This just protects it by enshrining it in state law. Does that sound right?
Yes, that's accurate. So not only codifying it, but outlining all of those specific requirements that are in MAPIA and taking those individual requirements and putting those into state law. So should at some point the federal government say, we're gonna delete the MAPIA law at the federal level or strike that, then we would still have that in our state law, and those protections would be in place for our residents.
And it's not expanding what's currently in federal law, correct?
That is correct.
Perfect. Thank you.
Are there any other questions? Hearing none, I'll read the cards. Not wishing to speak but supports the bill, inseparable. Not wishing to speak but support the bill, Jamie Zawuski with Aetna. Not wishing to speak supports the bill, Keith Lake Ahip. Not wishing to speak supports the bill, Adam Carlson, Michigan Health and Hospital Association. Not wishing to speak, spoke and supports the bill, Joseph Sullivan Diffs. Not wishing to speak supports the bill, Rory Lafferty Hap. Not wishing to speak supports the bill, Christine Shearer, Michigan Association of Health Plans. Not wishing to speak supports the bill, Alan Bolter, Community Mental Health Association of Michigan. Not wishing to speak supports the bill, Sherry Boyd, the ARC, Michigan. Not wishing to speak supports the bill, Michelle Roberts, Disability Rights, Michigan. Not wishing to speak supports the bill, Frank Waters, Michigan Primary Care Association. Not wishing to speak supports the bill, Melissa Holquist, Upper Peninsula Health Plan. Not wishing to speak supports the bill, Paula Ballman and Denise Hartzell, League of Women Voters of Michigan. Not wishing to speak supports the bill, Sarah Ishmael, Access. Thank you, Senator. Thank you, Joseph. Next on the agenda is testimony only on House Bill 5290 and Senate Bill 632. It sounds like there's a lot of interest in these bills, so I would like to let all members and guests know that if we run short on time, we will have a second week of testimony. Regardless of 1 or 2 weeks of testimony, all our guests wishing to speak will be given equal time. I do ask that each guest keep your remarks to 3 minutes or less. We will make a note if you have additional comments to make and we are not able to get to you. In the event we have 2 weeks of testimony, you will be welcome to come back for additional 3 minutes. I would also like to direct members' attention to testimony in front of you from a guest who was not able to attend today. Now, I would like to turn things over to our bill sponsors for testimony, Representative Abe Ayash and Senator Sarah Anthony. Please come forward. The floor is yours.
Good morning. Thank you, Madam Chair and members of the committee. Excited to come before you today to talk about an issue that I know has come up in discussion in past legislative sessions, and really hoping that we can finally address the issue that unfortunately has become, as I say, an albatross to people's ability to actually live their lives in the state of Michigan. So I'm excited to work with Senator Anthony on this legislation to put a cap on payday lending loans up to 36% on these loans. And I just want to contextualize some of these situations. We have some incredible stories here today, but imagine that you are someone that works at a fast food restaurant, and your fast food restaurant happens to be in a place that you have to drive to, and on the morning you have to go to your shift, your car breaks down. And the option that you have is to take an Uber, and you take an Uber, and the Uber is going to cost you about $45 to get to work. And after you come back from work, you realize it's not sustainable to take Ubers to and from work because the public transportation is not sufficient enough. So you go to a mechanic to try to figure out what it's going to cost to fix this car. You realize it's a transmission failure, and the transmission failure will run you about $800. You don't have that money readily available to fix it, but you need to get the car fixed. Otherwise, it costs you more to get to work and back to work than it does to actually make the money while you are working. So you go to one of these places that say get your cash now, cash advance or something like that, and you collect that $800 to then pay the mechanic to fix your car, and you start seeing interest accrue well beyond what the actual loan was. This is a vicious cycle that traps people into debt and poverty for decades and decades and decades. And this predatory practice, unfortunately, impacts the quality of life for so many Michigan families, and it prevents local communities from thriving, be it rural or urban. 70% of those that borrow payday loans end up reborrowing in the same day just to pay off the previous loan. And then 75% of payday lenders' revenue comes from borrowers that are caught in 10 loans in a single year. That's about one loan every 45 days. This practice is one that we can address in the state of Michigan to just simply say that an interest rate that is up to 370% does not make sense to try to help people get out of poverty. That if we are serious about allowing people to make responsible decisions for their finances, setting up a system where they are charged 370% of the interest, an interest rate of 370% to pay off what they actually borrowed, does not actually create financial freedom, but instead it puts you in a position of servitude towards these lenders for a long, long part of your life. So I'm going to pass it to Senator Anthony to talk more about the legislation, but we have an opportunity right now to simply set the cap at 36%, which is still pretty high. That means for every $100 you borrow, you're paying $36 on that $100. But it's better than paying $370 off every $100 that you have to borrow. So I'm going to pass it along to Senator Anthony, Madam Chair, to further discuss this legislation.
Thank you. Thank you, Madam Chair and committee members again. This is an issue that so many people have been trying to tackle in the last few years. I think back to the work of former Senator Tupac Hunter, who was one of the first voices to look at the current landscape of payday lending and say this is disproportionately impacting low-income families from rural and urban areas. I think back to some of our time working with Bill Sowerby, who was one of the longest advocates for this issue. And now we do have folks who are courageous enough to finally rein in an industry that, regardless of what you will hear, is predatory to individuals in every part of our state. The stories, and I will not speak too long because there are people here who will share their stories. And my only ask to you is to have their voices be the loudest. Not voices of politicians or special interests, but the voices of individuals who have disproportionately been impacted by this system. I was proud to witness in the Senate that this bill passed with bipartisan support, because lifting up people, giving people tools, and lowering barriers for people across the state is not a partisan issue. We saw men and women on both the Republican and Democratic side lift up their voices to say enough. That 370% APR is just predatory, no matter how you slice it. So that was exciting. The stories that I've heard have been from military families who currently enjoy a 36% interest rate. Our country, our society has said that for the men and women who have proudly served our nation, that an interest rate beyond 36% is just unnecessary. This bill would align with that. We've heard from family farmers who have said when their equipment breaks down and they need a short-term loan, they didn't sign up to repay thousands, they expected to pay $600 back. And we know that so many men and women who hurt because of a drought or a bad crop, that they all of a sudden are in a cycle of debt. You will hear from many women, and as we know, women will just make it work to make sure that a auto repair or children's school supplies are actually taken care of. And you'll hear from people who have literally lost their homes because of these types of debt traps. So this just caps it to 36%. We will hear stories that this disproportionately impacts low-income communities, communities of color, and rural areas across our state. 20 other states and the District of Columbia have all reined in this industry by capping the interest rate at 36%. I have modeled this legislation after a bill from Illinois. And we are now years after the bill has passed, and I am pleased to report that the sky didn't fall in Illinois, that there have been nonprofits, CDFIs, other organizations that have stepped up over the course of the last few years and provided tools for people who need short-term loans. You will hear that seedy actors and mob bosses and gangsters will all of a sudden start to threaten people and instill violence on folks because that's the only option that people in Michigan have. It's just a lie. We have data across the country to support the fact that the industry does correct itself. But I don't want you just to take my word for it. Do the national research yourself. We've spoken directly to lawmakers in states that this has passed, and there have been tools and resources that have been enacted. But lastly, I don't just want to speak to you as the senator from Lansing. I want to also speak to you as the Senate Appropriations Chairwoman. I don't want to leave it up to chance that men and women in this state who still need some type of short-term loan product won't have a place to go. So in this year's budget cycle, we are fighting for additional resources to give an off-ramp to families, to make sure that we are not overcorrecting the industry, but rather providing resources to instill an off-ramp for people so that those short-term loan products will be able to continue for people who need it. That is my commitment to you all as someone who's leading the budget negotiations. And I just strongly, again, urge you to listen to the voice of your constituents beyond any special interests that, again, have enjoyed lots of revenue, but on the backs of our residents in the state of Michigan. So thank you, Madam Chair.
Thank you, Senator Anthony and Representative Ayash, for your testimony. Do any members have questions? Representative Fitzgerald.
Thank you both for being here this morning and providing some background information on the development of the bill. And I just want to ask one thing, kind of relating to the 2005 regulations that were passed. I think that were intended to really support consumer protection, make sure that there were some guardrails here to make sure that I would say that the individual consumer wasn't necessarily losing their opportunity to continue to earn money and then pay these back sufficiently. So if we're replacing the current service fee structure with the APR structure, am I missing that today's service fee structure doesn't accurately capture the total cost of the loan, or how would the replacement of this service fee structure I guess be better for the consumer as a whole, because the term of these loans doesn't necessarily go into a full year or beyond. Can you just provide more detail on that?
So the problem with the current model is when folks are taking out some of these loans, these service charges, no matter how you try to describe it, when you talk about what the actual cost of paying back the loan is, the percentage of what you borrow and the percentage of what you are responsible to pay back is set up in a way where you basically have to go back into that system. So let's use the examples of individuals that actually have to take out the loan. I gave you the example of that fast food worker. That is someone that I know personally. And that individual does not make enough that if they took that loan out to fix their transmission on their vehicle, they do not make enough in the time period that they're supposed to pay it back, where the service charges keep adding up so that they then have to go get another loan. Mm-hmm. By setting the cap at 36%, we're not eliminating the product for these individuals to then go get that short-term loan. That is still available in these communities. But the reality is, currently, the system is set in place, and these lenders that are in these communities, the business model is set in a way that it almost demands that these people go back and get these loans over and over and over again, and that is how they're going to keep making their money, which is why I called it an albatross at the start. It's not something you can simply clip off by paying it, because the fees, whether it's $100 increments or whatever it may be, simply do not create a pathway to actually pay off that debt.
Thank you.
Thank you. And members, please keep in mind, we have a lot of people who wish to speak, so if we can keep our comments to 3 minutes, that would be appreciated. Representative Bruck.
Thank you, Madam Chair. Thank you for being here today. 36% APR. How long can you have a short-term payday loan? I thought they were capped at only a month. So 36% on $100 for 1 month is what would that total be?
So I'm going to ask you to hold that question because we have a couple of people who are literally experts in the field that can actually answer that for you, because I don't want to mislead you with the wrong information.
Okay, so I'm going to dovetail another question. You get a house loan, you have closing costs $2,000 to $5,000. That is not included in the percent that you get. It's not considered, part of the APR. So I just did it here, $3 a month. If you $100, 36% for 1 month is $3. What would one of these companies? This is a valuable service. This serves underbanked individuals normally. It's a emergency loan, and it's there for a reason, and it does help people. In spite of there's individuals that do get caught up and get in that cycle. I definitely would not argue that or against that. But the current structure, if it's only 36%, how will these companies stay in business at, $3 for a month? They do a payday, there's a lot of paperwork, et cetera. Will there be other fees that they can charge to these individuals?
Excuse me, Representative Bruck. We do have some subject matter experts coming up that could probably answer all of these questions for you. And they're coming up next.
Okay, already, I appreciate it.
No, they're coming up. Rep. Aragona, did you have a question?
Yeah, thank you, Madam Chair. Thank you guys for being here and bringing this up. If somebody, representative to your example, needed a new transmission, and they needed to go get I thought these were actually maxed out at only $600, but so let's say it's the max at $600. My assumptions were this was a carryover until the next paycheck, right? I don't have enough in my savings. I need the money now for a transmission to get to work for $600. I don't get paid for another 5 days. I need the money now. Yeah, I'm going to pay a fee, right? If they weren't going to go there, where else would they go?
So that's a great question. There are currently organizations throughout the state of Michigan that also provide these types of short-term loans. Nonprofits, CDFIs, even several credit unions provide this. You are right. They're called payday loans because it's a loan until the next payday. But what we see is that 70% of the people who borrow, the moment they pay it back, they reborrow again. If you didn't have the money before payday, you're not going to have it after. And so that's where the cycle really becomes illuminated. And the interest rates makes it almost impossible. But even currently in the state of Michigan, we have organizations that are charging much less than 36%. Habitat for Humanity, for example, which is a statewide organization, has already begun creating opportunities for short-term loan products and at a very reduced percentage rate. So it is possible, and it's much less predatory.
And do they have the capital to be able to provide these type of products in the market? I mean, do some of the charities have that type of capital to be able to fill in when needed? And then if they were to go to another financial institution, my understanding was, for instance, I've gotten an unsecured loan before, but the interest was not low. I was paying some interest on it, so I wanted to pay it off as quickly as I could. I had good credit, so I was able to get a lower interest, but it was still pretty high. So my understanding was, if you don't have the credit and you don't have anything to put up as collateral, it's tough to get a small loan to tide you over till that next payday. So
This is why so many organizations are stepping up and providing alternative products.
Okay.
So, yeah, and I think, again, as Chair Carter mentioned, there's several that will come forward and actually speak to some of those current programs.
And
Thank you.
if I may add, Representative, this is not a novel idea. nearly half of the states in this country have moved away from this predatory practice. And folks in those states who need short-term loans and are in a bind are still finding opportunities to get some of that funding that they need to address things like a transmission failure or childcare or something of those lines. So this does not eliminate the opportunity for people to get the help that they need if they are in a financial rut. It simply avoids a situation that if I have an $800 repair and I get that loan, and then I use the rest of my check to then pay off the remaining balance of that repair, now I have to go back and also pay the loan. It does not make financial sense for this individual to then to be able to go back and enter into a situation where they're going over and over and over again. And we mentioned the statistics, right? 7 out of every 10 borrowers in Michigan go back and get a loan the same day. So if this is clearly supposed to help them get out of that financial rut, if they're going back the same day, that likely tells you that they didn't have the money to pay back in 2 weeks because they went back the very same day to get more money. And the fees add up in a way where they're almost trapped in this position in perpetuity. So setting an interest rate allows the situation to be fixed, and we're going to have the experts to go over that further today.
Thank you.
Madam
Madam Chair, can I ask one more quick question?
No, we have to. But
Fair enough, thank you.
Reps, save all those great questions for the next group that's coming up that can answer. Senator Anthony, Representative Ayash, thank you so very much for your presentation, your testimony. And now we're going to move on and bring up some subject matter experts, you two down there. We're bringing up Lorraine Brown from the Michigan Poverty Law Program, Tom Hickson, Michigan Catholic Conference, Jessica Moody, Community Economic Development Association of Michigan. Would you please come up, please? And this is the lady that said the other two. She's from CEDA. Tom Hickson is from Catholic Conference. Okay. All right, everyone. Are you ready? Well, we're here to hear your testimony, and hopefully the committee can ask questions. Go ahead, please.
Yes, thank you. Good morning, Madam Chair.
Good morning.
Members of the House Committee on Insurance and Financial Services, thank you for this opportunity to provide testimony regarding House Bill 52 and 5290 and Senate Bill 632. I'm Lorraine Brown, with the Michigan Poverty Law Program and the statewide consumer law specialist with that program. Michigan Poverty Law Program is a statewide office that supports legal services programs throughout the state of Michigan. We advocate on behalf of the state's low-income residents in the areas of low-income housing, public benefits, elder law, consumer protection, and foreclosure prevention. The Michigan Poverty Law Program is pleased to support House Bill 5290 and Senate Bill 632, which will impose a rate cap of 36% APR and payday lending in Michigan. This will stop the payday lenders from charging up to 370% APR and protect consumers from spiraling into the debt cycle and experiencing other financial consequences. The 36% rate cap has broad support from other states, federal agencies, and the public. For example, a 36% rate cap is in line with what other states are imposing currently on small installment loans. In August 2020, an issue brief published by the National Consumer Law Center reports that at least in 45 states, plus the District of Columbia, the median APR rate cap ranges from 38% to 25%, depending on the size of the loan. Moreover, currently 20 states have, plus DC, have banned these short-term loans and limit them to 36%. Further, the Consumer Financial Protection Bureau adopted rules that prevent overdraft fees that exceed 36%. There's overwhelming support from the public for a 36% rate cap. Voters across party lines overwhelmingly support a 36% rate cap with ballot initiatives in Nebraska, Colorado, South Dakota, Montana, Ohio, and Arizona all enacted rates of 36%. According to the 2020 poll done by the National Consumer Law Center that was reported in their issue brief, a national poll was taken that found 70% of voters across party lines supported a 36% rate cap, and those who opposed that rate cap thought 36% was just too high. That's why they opposed it. In Michigan, the Center for Responsible Lending also did a poll of Michigan voters, and revealed that 67% of Michigan voters supported a 36% rate cap. Finally, I think we must consider how payday lending impacts the vulnerable communities here in Michigan. A 2018 Center for Responsible Lending study found that Michigan payday lenders target borrowers of color, in part by concentrating their locations in communities of color. As a result, a disproportionate share of payday lenders come from communities of color. Without imposing a rate cap, will continue to perpetuate the racial wealth gap, a racial wealth gap that we all became very apparent and aware of during the pandemic. But I will also want to add that a lot of questions whenever we come to this hearing, the main question is, well, what happens to the consumers if we limit the interest rate? Where will consumers go? Consumers won't have access to this credit. Well, the solution is not that consumers should have access to predatory loan products, but they should have access to affordable credit. We can look at the growing number of states that enforce a 36% rate cap and see that the sky didn't fall. As mentioned here, Illinois, when their bills were passed, immediately after the rate cap was imposed, we had a report that the Community Developed Financial Institution, the CDFI, whose generally interest rate is 13%, saw a 70% increase in application for loans. People were coming to them to apply for loans, so that's a source they can go to. Also, in Illinois, there were the new lender applications. More nonprofits were coming forth in Illinois to apply for the license in Illinois to issue small loans. In states like Montana and South Dakota, credit unions saw an increase in the number of payday lending alternatives. So the sky didn't fall there. And so I think also the study and the National Consumer Law Center published a study in 2022 in talking to consumers, and consumers found better ways to navigate their financial challenges when the rate cap were implemented, and more and more people were finding an increase for more options for affordable loans. So House Bill 5290 and Senate Bill 632 are much needed bills to protect consumers and to promote racial justice. So the Michigan Poverty Law Program, on behalf of Michigan's low-income residents, support these bills and urge this committee to vote on these bills. Thank you.
Thank you, Madam Chair, members of the committee. I'm Tom Hickson with the Michigan Catholic Conference and here today to support House Bill 5290 and Senate Bill 632. The MCC advocates for public policy to promote the common good. Our focus is to protect the most vulnerable members of society. And in this regard, we are grateful to Representative Ayash for bringing forth this legislation. And we also thank Senator Sarah Anthony for her years of leadership in preventing predatory lending, culminating in sponsoring this legislation. MCC has been involved in advocacy on this issue for many years, from the inception of legalized payday lending almost 20 years ago until today. Much has changed. We now have nearly 20 years of data that demonstrates the devastating cycle of debt these types of loans trap people in. The loans have an APR approaching 400%. And as we've heard already, nearly 70% of borrowers take out a new loan the same day they pay off another loan. A full 90%, we haven't heard this, take out another loan within 30 days. This cycle of debt is not easily broken. Perhaps the most egregious thing about these loans is the business model, and we have already heard nearly 75% of the revenue generated from these payday lenders, or earned by the payday lenders rather, are from borrowers who take out 10 or more loans per year. This system is designed for repeat borrowers. The previous 4 sessions have seen bills introduced to expand high-interest payday lending to larger dollar loans. These bills have not been enacted largely because lower interest loan options are available. I shared a handout with you all today, and it looks kind of like this, or exactly like this, and it shows all the different options that we're aware of. And even this morning, I'm aware of a new credit union here in town that's 2 credit unions in town that are not on this list that offer unsecured, lower interest loans. These documents have to be updated quite frequently because of the new options are appearing regularly. The one I'm most familiar with is St. Vincent de Paul, down here on the corner of the sheet, and it offers a micro loan of $750 for 3% interest, payable over 18 months. The idea is to educate folks on financial literacy while helping them in a pinch. Today's legislation is very timely and appropriate. Capping loan rates at 36% is in line with regulations placed on lending to active military service members. This is quite a high APR anyway, but it's very much better than what's in the current law. The rate cap for those in the military was established to protect the security of our troops from getting into high debt and compromised situations and jeopardizing their clearance status for getting on base. If the federal government and numerous other states have seen fit to protect their residents, their citizens from a huge rate and putting a rate cap in place, Michigan should do the same for our residents. There's one last point I'd like to make. Often there's confusion that payday lending is a tool to help the unbanked. The fact is you need to have a bank account, a checking account specifically, to take out a payday loan. These loans do nothing to help individuals who don't already have a bank to get access to cash. And with that, I'd urge the committee to support House Bill 5290 and Senate Bill 632. Happy to answer questions.
Thank you. Thank you, Chairwoman Carter and members of the committee for allowing me to speak today. I'm Jessica Agwoody. I'm the Policy Director at CEDM, which is the Community Economic Development Association of Michigan. We're a statewide membership organization with more than 300 members engaged in community-based economic development around the state. Our members work to revitalize and strengthen communities and help residents build financial security and generational wealth. You have a longer letter from the Michigan Coalition for Responsible Lending, which CEDM is the head of, and you'll see from the sign-ons to that more than 100 organizations who support these bills that are coming before you. And that coalition is actually nonpartisan. We have rural and urban populations. We have Republicans, Democrats. We have independents. We have veterans, credit unions, and locally based nonprofits. I'm not going to repeat what everyone has said. I think we fully understand the impact of these loans have on these communities. But I just want to point out, in 20 other states, as everyone has said, they cap interest rates on these small dollar loans at 36% or less. There are actually 8 states that have never legalized these loans, and that includes West Virginia, Vermont, Connecticut, Massachusetts, New Jersey, New York, Pennsylvania, and Arkansas. People in those states have access to responsible products. They're not going to their corner loan shark. And what we also saw, I want to point out, most recently in Illinois, who passed this 36% rate cap, they found that while payday lenders chose not to operate under that responsible rate, more affordable installment lenders expanded their business in Illinois. The Woodstock Institute found that since the rate cap, there are 172 new lender licenses and branches in Illinois. I also wanted to point out South Dakota did a similar rate cap that they passed, and storefronts formerly occupied by payday lenders are now revitalized as restaurants, churches, credit unions, and other communities contributing businesses. While the payday lenders argued that few options existed for borrowers no longer able to obtain a triple interest rate loan, they found that credit is available and the credit economy for individuals in South Dakota is stable. So in all 20 states that don't allow these predatory loans, CDFIs, credit unions, nonprofits, all of them have stepped into that space to offer responsible lending at a rate usually less than 36%. I know that you'll hear arguments that since payday lenders are charging fees, it's technically not an APR and they are short-term loans. But what we find is people take out these loans, they can't pay it back, they take out another one because you can have up to 2 at $600. They end up trapped in these loans for at least a year. So that APR is actually accurate. So thank you for your time. Again, we wholly support these bills and happy to answer any questions you may have.
Thank you very much, everyone, for your testimony. Very informative. What we're going to do now, and I would like to inform the committee that we do have another group of people wishing to speak, but because we have designated these three as our subject matter experts, okay, I would like for you to ask any question that you'd like, but try to limit it because of the time constraints we have. So do we have any questions? Okay, we're going to start off with Rep. Fitzgerald. Please limit your response.
Thank you all so much for being here. Really helpful testimony. I just wanted to follow up on one point with regard to the bank accounts. I didn't realize that you had to have a bank account to get a payday loan. This is, I think, really critical. We've talked a lot about financial literacy and financial aptitude when it comes to navigating, standard banking practices. If you have a checking or savings account with any of these institutions, why are we not able to see an uptick in available lending and capital through those traditional banking or credit union institutions? And with regard to some of the, like the Catholic Conference's ability to lend as well, do you have to be a member of the Catholic Church to access that? So those are my two questions.
I'll answer the second one first. No, you do not. We'll serve anybody.
I think what we've seen is that while credit unions do have alternative products, they do not have the marketing dollars to compete with the payday lenders. And a lot of times in communities, it's, a street on the corner, you can walk in, you can walk out with that $600 in your pocket. It's not intimidating, it's what people know. To your point, we're not just working on capping these. Our members are actually working in communities trying to educate people on the issue and grow their financial literacy.
Thank you. Representative Bruck.
Thank you, Madam Chair. Thank you, folks, for being here today. Is in the other states where they passed these laws that limited the amount, did they lengthen the time available for paid? Because, correct me if I'm wrong, like a payday company or payday institution is technically not a bank. They're like a parabank, if you will. They can't loan money for like a normal financial institution. In these other states, did they lengthen that time that they could actually loan out that cash?
I can go and then you can take it if you want. That's a really great question. Thank you for that. There are some states that have lengthened the terms of the loans, but we also have in Michigan the Regulatory Loan Act. You can get licensed to loan under the Regulatory Loan Act. You can loan longer term loans. I think it's up to, is it 25% APR? So there are mechanisms in this state to provide longer term loans, not just those 2-week loans.
What prohibits a payday lending company from doing that currently?
Yes.
Correct. As someone who was here in 2005 with the new bill and was part of the
Appreciate that perspective too,
But
yes.
yes, as part of the position of the Michigan Private Law Program, that the payday lending in 2005 should be complying with the Credit Reform Act, the Regulatory Loan Act, and complying with the 25%. And their position was they should be exempt from the Regulatory Loan Act and not come under that, and therefore should not comply with the 25%, which is why we have this bill. So it was their argument that was brought that they didn't come under that Regulatory Loan Act, and they developed the Deferred Presentment Services Transaction Act, which is why they don't now comply with the 25%.
Okay, roger that. So I guess one of my worries would be if they're limited to only 30 days, they can only charge 36%. It's $3 on the 100. No business. You can't do anything for $3. Maybe buy a hamburger when they're on sale. But, that's what kind of worries me. But maybe, there are other options. We're seeing that. The average credit card is 28%. And I did look it up. The average balance is over $6,500 for the average American, which I have zero. So that means other people have a lot more. But yeah, but I appreciate you folks being here today very, very much.
Thank you, Rep. Bruck. Rep. Harris.
Thank you again, Madam Chair. Again, thank you folks for being here. I think this is definitely a topic that we need to have an open mind and really think through both sides of this. I just want to piggyback off of one of my colleagues' comments. So if these folks have bank accounts already or accounts with a credit union, and we have these alternatives out there already besides payday lending loans, why are people still going to the payday lending loans that are such a higher interest rate versus going to all these other options that they may have with their own financial institutions or all of these other groups? And if these other things are accessible and available, I mean, wouldn't they be going here anyhow?
I think one of the surveys that the National Consumer Law Center did when talking about after the aftermath, after the payday lending has been capped, a lot of the consumers reported that it was just easier to go to the local payday lender to get it versus going through the trouble of the bank. But also, a lot of the other lending institutions didn't really find that as their space to be in, so therefore they did not go there, and they weren't as affordable now. But what we're seeing is once the cap has been implemented and the payday lenders, or some of them, are pulling out, we saw then room for the other industries, such as the nonprofits that are applying for new licenses to lend loans. They're now coming back into this space. So yes, they weren't there in the space then, now, and that's why it was easier and accessible for consumers to go to the local neighborhood payday lender and to get it quickly and fast. Now we're seeing a lot of the nonprofits now are moving into this space to provide affordable loans.
And credit unions. And credit unions that weren't offering it as much earlier, and now they are a lot more. I just saw one today. It was MSU Federal Credit Union, 28%, 6-month loan.
I will say too, we have heard from borrowers who got caught in these traps that a lot of it is a financial education issue. It's my parents went to payday lenders. I didn't realize I could go to the credit union or bank and get a loan, so I just went to my local shop. You'll hear from some borrowers though.
Representative Aragona.
Thank you, Madam Chair. And I will keep my questions very quick. I promise. 2 quick questions for you guys. One, we've talked a little bit about this kind of debt circle that's happened. What are the, if I go into a payday lending facility, get a loan, need to pay off that loan because I'm still having issues, I go get another one. How many times can I do that in the state of Michigan?
So technically, according to the law, you can have 2 loans out at a time, and you have to pay off one of those loans to get another one out. There are ways around that. Payday lenders just have to close out the loan in the database. So let's say I go to one shop on one corner, I take out $400, I can't pay it back in 2 weeks. I can go to another shop, take out a loan, go right back and pay that one off, so that gets closed off. So now I technically only have 1 loan out, but I can keep rolling those over indefinitely.
Okay. Do you find that happening a lot?
Yes, as statistics that were shared from the Consumer Financial Protection Bureau, 70% of borrowers in Michigan reborrow the same day they pay off a previous loan, and 90% within 90 days.
Okay.
Reborrow.
And then you had mentioned, last one, banks and credit unions also are providing some of these products at a lower interest rate. What's the normal origination fees and closing costs on an unsecured loan that would be smaller like this?
That's a great question. I know Lorraine knows more
The
about that.
CDFI, their average one is 13%, but also in terms of smaller loans, the Michigan has the Regulatory Loan Act and the Credit Reform Act, which is a 25% APR.
And that's
interest rate.
inclusive of fees,
Yes,
correct?
yes,
So it'd be 20% on top of the APR,
25%.
25% on top of the
Yes.
APR.
No,
total. 25%.
Including fees.
Yes, including
All
fees.
inclusive.
Yes,
Okay.
all inclusive,
U.S.
yes.
Bank, your flat
Yes.
$6 fee for every $100.
So they're actually small lending institutions that are making these small loans, but they have to comply with Michigan's Regulatory Loan Act, whereas the payday lenders don't.
Okay. Thank you.
And if I may add one more thing, we talk about people getting caught in the cycle of loans. I'm sure that the payday lenders are going to say they offer a payment plan for people who can't pay back their loans. I will say the borrower has to request that, and a lot of borrowers are not aware that they qualify for that. And so we don't And the people that keep reborrowing, we don't see them entering a payment plan.
Okay, we have time for two more questions, one coming from Representative Breen, and then the final question from Representative Young.
Thank you. I think you already touched on part of this. I understand one of the takes here is, you have to have personal responsibility. It is your choice to take out one of these predatory loans. It is your choice to pay it back or not. And so there does, I believe, have to be some accounting for personal responsibility here. But on the flip side, again, a lot of people just don't know. My concerns really are twofold. One is, and you touched on this a bit, the lack of awareness for these alternatives on this wonderful sheet. And Mr. Hickson, I sent you that information on MSU-FCU. I didn't even know about that. So I would like to know what your suggestions are to help raise awareness about these other options. And also I am concerned about, as again, some of these require enrollment or belonging to these credit unions. What about those folks who don't belong to something, they need something besides St. Vincent de Paul, they can only be stretched so far, but what about people also who have low credit scores? What are their alternatives? Do you have any suggestions for that public awareness campaign or for people who have low credit scores?
I know, again, going back to Illinois, since that was the most recent one, I know in the report, in their study of the aftermath, the CDFI, they did a major PR campaign right after this, and that's probably one of the reasons why they had an immense increase in their applications for loans, 70% increase, but they had went out and did an intense campaign. So I think, yes, a lot of these companies and loan nonprofits can do this likewise by doing an intense PR campaign of their availability of resources.
I guess sounded like Senator Anthony was working on something in the budget, so that might be a good opportunity there too.
Thank you. And the final question coming to this panel will come from Representative Young.
Thank you, Madam Chair. Thank you all for being here on today. So appreciate it. So one of the things, I was on financial services my freshman term, last term, and there was a map. There was a map of where all these different types of institutions, yeah, my colleagues, we were on it together. And so I haven't seen that in this presentation. So when I'm looking at this and I'm thinking about equity and I'm thinking about access, I'm thinking about folks who don't have transportation. And so they can't even get to some of our financial institutions. So they just go to the first thing. So the first thing is this place, no matter how much you're charging, I got to do it because I'm desperate. And so I'm thinking about this in a way of eliminating desperation, which is costing folks so much more. We're looking at people who are already currently living paycheck to paycheck. So when you're borrowing off a paycheck that's already spent, the one that you're getting in the future is already spent. And now you owe off of that. That's how you end up in the cycle. And they're continuing to tell us that, well, these are people that are working. I understand they're working, but they're the working poor. I'm a legislator. I feel like I'm the working poor, let me tell you. And so I'm just trying to understand. And then we get into this whole thing about, words. So APR versus fee. I mean, let's just strike all of that. Now, I'll draft a law right now and say we're just going to call it APR, right, and get rid of the term fee so that we're all speaking the same language. So, but, let me hurry up and ask a question. Where's the map? Because I feel like we're dealing with an equity issue, and I don't know that these are everywhere necessarily. Like I feel like I'm told that they are, but I'd like to see it, Jessica. So yeah, where's the map?
I can get you that map. It is from a 2018 report. Just to warn you, it's a few years old, but I think it will at least give you an overview of where these stores are located. And you're right, it's absolutely an equity issue.
Thank you, Madam Chair.
Okay, thank you, panel, for those great answers to our questions. I'm sure if we had a lot of time, you'd be here till tomorrow. Okay, but we do have thank you for saying. We do have two people who want to come up. I'm going to ask Samika Douglas and Dallas Linear to come up and tell their stories, if they don't mind. Yes, and because we're running short on time, please limit your comments to 3 minutes. Thank you.
Good morning, and thank you so much for allowing us to be here. Protocol has been established, so again, we'll just get right into it. My name is Dallas Lanier. I'm the Executive Director of Project Green, which is the Grassroots Economic Empowerment Network, a nonprofit organization based in Grand Rapids. Our mission is to help families to rewrite their financial legacy, and we do that through financial capabilities, programming, as well as economic advocacy initiatives. We've been working to move Michiganders away from asset-reducing products and services like payday loans for 6 years as a nonprofit, and for many years before that as community volunteers. Payday loans are a financial collision at the intersection of legitimate financial need and perverse greed. It is true that there are millions of people in our state who struggle to make it from paycheck to paycheck. However, payday loans actually make their situation worse, not better. It's almost as though someone is sick and we, as I heard a community member say many years ago, they're provided with poison rather than with medication. One Grappidian named Regina shared her story with us. I'll just share a few comments that she provided. She said payday loans are utilized by folks who are at probably the lowest point in their lives. The shame and stigma cast on people who cannot make ends meet allow these companies to continue to exist. To a desperate person, payday loans often seem like the only way to get help when really they are walking into a devastating trap. And she shares that she walked into that trap. She said she used payday loans on 2 occasions. I won't get into all of the details for the sake of time, but I will just say that she said that it was a devastating mistake. She said she couldn't pay back the amount that she borrowed. It kept growing beyond anything she could imagine and anything that she could manage. Within 2 to 3 months, where she originally borrowed $600, her loan amount was eventually bubbled up to over $1,400. It ended up with her wages being garnished, several months of homelessness, bankruptcy, and the end of her pursuing her PhD. And she said, quote, "That's a very high price to pay for simply being poor." On just this past Monday, I was at another community event. I mentioned the work that we do, particularly around payday loans and trying to steer people away from that. Immediately, this new colleague that I met began shaking her head, and she immediately knew of a neighbor of hers who had been caught in this same debt trap, and she began to tell that story. Those are the stories that we have been hearing for years. We've surveyed nearly 400 people. Over 80% of those people said that payday loans did not help their financial situation, and indeed, oftentimes made it worse. Our neighbors like Regina, who shared her story, and others that we've talked to, they deserve better. When they are financially limping, they don't need to have the weight of 370% APR strapped around their ankles. They deserve the same protections as our active military personnel, as you've already heard, who are protected by a 36% rate cap. And I'd say it's time for a 30% rate cap here in the Mitten State. We're working to create alternatives through credit building loans, through churches, nonprofits, and other financial institutions.
Dallas, we have to move on. Thank you. Please.
Thank you all for having me here today. My name is Samika Douglas, and I am a victim of payday lending. Years ago, my husband and I had, matter of fact, young man pretty much described my issue. Car broke down, going to school, working full-time, as Rep. Young stated, working poor. Went to payday lending, borrowed the money because they were right there. We needed it right then and there, couldn't wait. They were right there on the corner. Every corner you turn, they're right there. And unfortunately, I do live in an underserved community where all the payday lendings are. So we go to the payday lending, we borrow the money, and of course they give you this 11 by 17 page of information, and of course we don't read it. You know, we do not read it. Again, we don't have that financial literacy when we step into these places. Some of us still don't have that financial literacy, even to manage once we do get the payday lending. So we go there, we get the monies, and now it's time to pay it back. But on top of paying that back, as you stated, I also have other bills. So now I have to reborrow again because I also have to pay these fees. It's not just the paying back the monies, it's paying back the fees that continue to occur. And what they do also is they do trick you. They tell you, yeah, you could come get this money, no problem, but they don't tell you that these fees are going to occur at a high rate for you. You can't, of course, they give you the paperwork, and yes, it is up to us to read the paperwork. It is our responsibility. However, when you're in a situation, you're not looking at all those things.
Thank you so much. Because we are short on time, I do want to move on. We really appreciate your testimony. I do live in a community similar to yours, so I understand your story. Okay, so what we're going to do is thank you very much for your testimony. We're going to have John Ravenold come up. He is going to testify in opposition to the payday lending bills. Please come up.
Madam Chair, members of the committee, good morning. My name is John Ravenold. I'm with Check and Go, a licensed deferred presentment company since the beginning. So I've been here quite a bit since 2005, since the enactment, and there's just a lot to unpack, which I'm unable to do in 3 minutes. So let me just hit some high key points. I'd like you guys to consider the testimony that you hear from our customers, and I make really no apologies for opening in your districts and retaining, hiring people in your stores and serving your customers. It's a choice that customers come to us. They all have relationships at a bank or credit union. Those aren't being met, and those are really the folks you're kind of going to harm. When I heard the example of an $800 example, that's a violation of the statute, and you're going to get more of those stories, not less, if you eliminate the regulated entities in the state. The cost is a fee-based service. It does not accrue. No one pays $370 on a $100 loan. It's an APR disclosure. It's an important disclosure we make. It's usually used to compare to other like service products, like paying a bill late or paying a credit card late and getting that fee, but those are not disclosed, and so our customers rely on the dollar cost representation. And at $15 $100 or 13% of what they borrow, they find that to be a better option than paying their credit card bills late or missing a utility payment or getting hits on their credit reporting. We have limits in this law. We have off-ramps in this law that that really address. And so there's reasons why you don't have people in 26 loans a year. Even the advocate said 10 a year. There's 26 pay periods. So people, if they're looking at paying a bill late or missing a payment, they use us as they need it and then pay it back with off-ramps that are designed to help the constituent. But you'll get more of the bad stories if you eliminate the regulated guys. And I tell you, the one thing I point to is one thing that really we listen to a lot are complaints. There were probably over 500,000 transactions last year, which the database, the bill you all voted for, 4343, will reveal all this. 500,000 transactions. You had 16 consumer complaints. That's a good record. I'm here on behalf of my employees that are here that do a really nice job. They're they're tenured. I encourage you to meet them. They will tell you stories. And then go into my store and meet the customers that are there. They'll explain it to you why they're there or why the bank or the credit union was unable to help them. And even, my friend from the Catholic Conference, now I'm a Lutheran and all, but his answers, those are where my customers come from. He's mentioning some of the banks. I have bank customers. Lake Trust Credit Union, for some reason, doesn't like us too much. I have thousands of their members that use us from time to time because they don't want to pay the $32 bounce check fee. They don't want late hits on their credit reporting. there's just a lot of harm that I think you really need to consider. And then I'll end with this, Madam Chair, and you've been very generous with me. Thank you. Your constituents borrow hundreds of millions of dollars, okay, for which they pay 13%. That's the fee, the total finance charge. If you look year over year, that's all they pay. This stuff does not accrue. I'm sorry, it just doesn't. The law doesn't allow it. We disclose it as an APR because it's an important disclosure required under both federal and state law. But customers are spending dollars, and a licensee cannot operate at $3 with lending $100 to people who are, let's call them credit challenged. One bad loan under this law requires 76 good ones. So I have to have a batting average of 98.7% to recoup the losses of one loan. So it's a prohibition. I discourage you from eliminating what I think is a well-regulated industry, and I think they do a nice job for your constituents, in my opinion.
Thank you for your testimony, and to be fair, we're going to open it up for questions, but we're going to ask that we limit the questions very, we really are about to run out of time, but we do have questions, and committee members, if you can limit the time to your questions. Okay, we have Representative Aragona.
Thank you, Madam Chair, and I will keep it very, very quick. Sir, I think you called it a batting average, right? So if you lend out $100, you're getting $3 on that a month. If you lose one of those, you got to make that up somehow, right? You got to be able to come back. So what is, without this legislation, what is your, in your words, batting average right now? How many loans are getting repaid? How many aren't?
Madam Chair, Representative, bad debt's obviously a big issue for us. We try and keep it limited. It's at the end of the day when we work with customers, whether it's extended payment plan or trying to avoid fees, which we actually don't charge for bounce checks, we try and get it down to under 10%. I mean, if we could be 95%, again, working with customers to get them to avoid the write-off. But yeah, we need to get it that high. I mean, it's even the losses under current law, you got to go like 6 or 7 to recover the losses from one bad loan here.
Thank you. Representative Young.
Kind of a rhetorical question, maybe. I'm just trying to figure out why one group of Americans get 36% and another group of Americans shouldn't.
Yeah, Madam Chair, the military rate was passed in 2005, part of the National Defense Authorization Act, and they were concerned about, the industry outside military bases. It was not a large consumer base for any of, certainly not for my company, and enlisted personnel, they're doing a job. I mean, it's pretty honorable, but they don't get the loans. They don't borrow $300 from anybody because, as even banks and credit unions acknowledge, a $300 loan for 2 weeks at 36%, really, you can't, it just doesn't work. And so it's not that they're getting money, it's just there's no product available for them.
We good?
Okay, I'll look into that. Thank you.
Yeah.
Last question, Representative Bruck.
Whoa, thank you, Madam Chair. Last, thank you. Question on the term of the loan. If, obviously, I think no one could make it on $3 for a transaction. I think that's clear if it's 36%. What would be an agreeable or possible service charge, or would lengthening the amount of the loan time, is that even possible, that would allow you guys to still perform your services?
Yep, Madam Chair, Representative, this was asked earlier too about extended repayment plans. After a 8th loan in a 12-month rolling period, you get an extended payment plan of 3 terms. I've long encouraged amending either the Regulatory Loan Act or the Credit Reform Act to allow for this product to be treated in that way, having multiple installments. That way you get multiple payments of income. And our experience has been customers like having that advantage. Absent of that, what we've seen when states pass 36%, Illinois, New Mexico, the average loan goes from 400 to like 5,000. And so you're no longer fitting the need of the borrower, you're fitting the need of the lender who needs 36 months now at 36% at $5,000 when the person really only needed $500. And so that's kind of what happens when you create these arbitrary limits. The market will respond. And if people think we're overpriced now, why aren't they taking my customers? I serve 40,000 Michiganders. Half are at a bank, half are at a credit union. But they come to me. They have relationships there.
Okay, we're out of time. We have a
Thank you, ma'am.
bunch of cards to read in. Yes.
We do not have time.
Thank you. Okay. All right, I have a lot of cards to read in. What we have is people who were scheduled to speak, but we ran out of time. And supporting the bill, Jen Root, SEIU. Kelly Ellsworth supports the bill. Monica Burke, Center of Responsible Lending, supports the bill. Ross Yudnek from DIFS supports the bill. Paula Cunningham of AARP of Michigan supports the bill, not wishing to speak. We have Patrick Schaefer of Michigan League of Public Policy supports the bill, didn't wish to speak. We had Todd Tennis, Center of Civil Justice, supports the bill, not wishing to speak. We have Heath Laurie, Michigan Coalition to End Domestic and Sexual Violence, not wishing to speak, supports the bill. We have Amanda Klein, United Way of Southeastern Michigan, not wishing to speak, supports the bill. Seth Johnson, United Way of Northwest Michigan, not wishing to speak, supports the bill. We have Robert Jorg, Michigan Laborers District Council, not wishing to speak, supports the bill. We have Michelle Van Dyke, Heart of West Michigan United Way, not wishing to speak, supports the bill. Lindsay S. Reams, Grand Rapids Housing Commission, not wishing to speak, support the bill. We have Randall, Kent County Essentials Need Task Force, not wishing to speak, support the bill. Doug Baum, NIMCOG, Northeast Michigan Council of Governments, not wishing to speak, support the bill. We have Gail Hill, Allegan Homeless Solutions, not wishing to speak, support the bill. We have Rebecca Kick, City of Kalamazoo, not wishing to speak, supports the bill. We have Steve Jambinga, Lansing Regional Chamber of Commerce, not wishing to speak, support the bill. John M. Williams, Habitat for Humanity Michigan, not wishing to speak, supports the bill. Rebecca O'Connell, Lake Trust Credit Union, not wishing to speak, supports the bill. Adrika Jacobs, Lenawee County Department of Veterans Affairs, not wishing to speak, supports the bill. Thomas Visco, Michigan Community Action, not wishing to speak, supports the bill. Bobby Duringo Jones, Michigan Association of United Ways, not wishing to speak, support the bill. Glenn Wilson, Community First Incorporated, not wishing to speak, support the bill. Norman G. DeLis, Michigan Disability Rights Coalition, not wishing to speak, support the bill. Andy Shore, City of Lansing, not wishing to speak, support the bill. Vanessa Boo, Manistee County Human Services, not wishing to speak, support the bill. We have Michelle LaJoy, Community Action Alger Marquette, not wishing to speak, supports the bill. Karma S. Peters, Michigan Legacy Credit Union, not wishing to speak, supports the bill. Zach Fosler, Ypsilanti Housing Commission, and not wishing to speak, supports the bill. Dwayne Barnes, Detroit Future City, not wishing to speak, supports the bill. Ruth Johnson, Community Development Advocates of Detroit, not wishing to speak, support the bill. Martin Carter, Astera Credit Union, not wishing to speak, support the bill. Hank Hubbard, One Detroit Credit Union, not wishing to speak, support the bill. Okay? So we don't want to do the oppositions?
Yeah, we can.
Okay.
We're running out of time.
Okay, and we do have a couple more bills to read in opposing the bills. We have Greg Whitmer, Finance, not wishing to speak, opposes the bill. We have Julie Townsend, Purpose Financial. She opposes the bill because it's a yes. Okay. And Sarah Foss, Advanced America, opposes the bills. Okay, I think we've got through everything. So now we need a motion to excuse Representatives Grant and McFall, and Representative Scott makes the motion. Hearing no objections, Representative Grant and Representative McFall are excused. Well, seeing no further business before the committee, we need a motion to adjourn. Rep. Nyer has raised his hand. So, hearing no objections, we are adjourned.